Hello, my name is Kyle Rodda and welcome to this week's Investor Spotlight. It is the season to be jolly, or is it? In this week's episode, we review what happened last week in the US earnings season with a particular focus on the financial sector and one major consumer stock. Expectations were low heading into this US reporting season. Based on data compiled by FactSet, coming into the earnings period, S&P 500 companies were tipped to deliver earnings growth of 2.8%. After 1 week, that number has already fallen, with current consensus estimates suggesting the quarter ought to deliver a paltry 1.6% in EPS growth for the third quarter. The problems appear to begin at the top line for companies. Based on the same set of data, revenue growth is expected to be 8.5% for the third quarter. That's low by historical standards and a scratch below the 8.7% analysts had been estimating prior to the period. In addition to weaker sales, higher costs are also weighing on the profits of companies. The big story so far this week, as it always is, was the first batch of financial companies reporting. While there's a handful of names still to report, those that did last week were generally underwhelming. Estimates for EPS growth for the quarter have slipped from 12% to 16.2% in what's simultaneously an omen for the broader market as well as the US economy. Here are 4 companies that handed down results for the week. Bucking the dour start for US earnings season was PepsiCo. The business managed to soundly beat earnings estimates, posting EPS of $1.97 per share versus $1.84 expected on revenues of $21.97 billion, which beat the $20.84 billion forecast. What was even more heartening was the company's outlook provided. CEO Raymond Laguarta said that despite rising costs, the subsequent price increases are successively being absorbed by consumers. He also said the consumer overall is in a very healthy position. That was enough to see the company increase its earnings forecast from 8% to 12%. The picture was more mixed for JP Morgan when it delivered its quarterly results last week. The bank managed to beat earnings estimates, posting EPS of $3.12 against forecasts of $2.87, thanks to a rising interest rate environment. However, the number was still down 16% from last year, with loan provisions and losses in the bank's financial assets a drag on profits. JP Morgan CEO Jamie Dimon did deliver an upbeat assessment of the US economy, suggesting households were in a healthy position. However, Dimon did highlight growing headwinds to the US economy, which range from inflation to tighter monetary policy and energy insecurity. Wells Fargo's results were arguably the best of the US banks last week. The company posted strong earnings growth of 6.56% on EPS that came in at $1.30 against a $1.09 consensus estimate. The bank also posted stronger than forecast revenues with top-line growth of 3.6%. It also increased its dividend payment. In a sign of caution about the outlook for the US economy, Wells Fargo also boosted its loan provisions, setting aside $784 million for potential bad debts. The bank CEO, Charlie Scharf, talked up the strength of US households and businesses, however, stating that both remain in a strong financial position. As America's most mortgage-sensitive bank, Wells Fargo did highlight the risk to profits of rising interest rates. Citi's results from the quarter soundly beat expectations, although the theme of much weaker annualized earnings growth for the sector rang true. The bank posted EPS of $1.50 for the quarter, beating expectations of $1.42. That was a drop of 30% compared to the corresponding period last year. The bank also increased its credit provisions in anticipation of greater delinquencies and defaults going forward. Its investment banking arm also struggled and posted weaker than expected results as slumping asset markets hit revenues. CEO Jane Foster was perhaps the most somber about the outlook for the economy amongst CEOs of financial sector companies. She warned of rolling country-level recessions across the global economy, with the US likely to experience a mild recession in late 2023.